The Fed surprises markets, but are soft landing hopes still alive? Welcome to Market Insight. I'm Ludovica Brignola. The US Central Bank now en route to just one rate cut this year. That's the conclusion drawn from yesterday's FOMC announcement, in which a revision to the Fed's famous dot plot came as something of a surprise, now penciling in just 1/4 point rate cut this year, as opposed to the 3 previously expected, with that single cut now not seen until much later in the year. Joining me now to talk about all that is Anna Rathbun, CIO of CBIZ Investment Advisory Services. Thank you very much for being with us today. Right, so the dot plot yesterday showed lingering concerns that inflation would remain well above the Fed's target of 2% for longer than policymakers had initially thought. Is this not countered by yesterday's softer than expected CPI report and today, which has been followed by an unexpected fall in May PPI?
Yeah, so we found out yesterday at the press conference that the Fed officials, the voting members, had an opportunity to take a look at that CPI, but we still got the message that we did. So I think we are looking at a higher for longer environment, certainly than what we expected back in March. Now, if you take a look at that CPI a little bit under the hood, the things that are driving the prices down, number one was energy, which could pop right back up depending on what happens to supply and demand. And the other thing was goods. It was mostly driven by goods. Services were still up. If that goods disinflation at some point stalls, we could have an upward surprise in the inflation print. And I think that is what the Fed is wary of. So the Fed is being very conservative and careful on their projection and erring on the side of inflation being stickier than not. And so it was kind of interesting to see the markets actually rally when the Fed was hawkish, but the markets certainly rallied on the CPI number, but the Fed is going to probably stay the course in what they believe will happen for the rest of the year.
Interesting. So potentially stickier for longer. Now, markets are now betting on December as a first rate cut in the cycle. Do you agree, or could one cut come earlier than that?
Well, I think it could be November or December. Our position has always been that we would probably get one cut in 2024, if we get one at all, and it would probably be after the U.S. election. So I think November could be in play, and that was certainly starting to be priced into the Fed swaps market yesterday. But it could definitely be December. I think the Fed and we don't always agree, but certainly yesterday we came in line.
Where are the risks, do you think, in the labour market? Because we are seeing mixed messages there. High non-farm payrolls, but then soft JOLT reports and ADP as well. Now unemployment ticking up to 4% as well. What's your take on the labour market?
Well, the labor market has been very confusing for a while. So we have to take those large non-farm payroll gains with a little bit of a grain of salt. The 272,000 jobs gained that we talked about last Friday, that actually goes through a lot of econometric modeling. And therefore, nobody's out there actually counting those jobs. Now, if you look at the household survey within the same report, you saw a massive decline in the number of jobs. So when we look at those contradictions in the same report, we have to say, okay, are we at an inflection point in the labor market where we are hearing different things from different types of surveys and different corners of the economy? When confusions like that happen and not everything is pointing in one direction, it's time to pause and start to pay attention. This morning's the initial claims came in a little bit higher, and last week's also came in a little bit higher than expected. These are the things that we're seeing in the fringes that could potentially be signaling weakness in the labor market. We're not weak at this time, but we need to start paying attention to those signals.
And do you think that a soft landing is still intact? And does that account for the relative lack of market distress over the Fed projections that we saw yesterday on the markets?
Well, the markets are hoping that the rates are going to be cut sooner rather than later. And as I said earlier, I do think that the Fed needs to start cutting, and that really is the only way to achieve soft landing. There are areas of the economy that are interest rate sensitive, that are under stress. They may not be marked in the books right now, but once there is a forced transaction, a lot of the sellers of those assets may be finding themselves in a new territory. If we start cutting rates sooner rather than later, it will take a lot of burden away from small businesses as well as consumers that actually rely on financing to lead an American life.
Interesting. One last question on Tesla. Shareholders at Tesla's AGM are due to vote on a $56 billion pay package for Elon Musk today. Is he worth it?
Is he worth it? Well, stock market is up with some of the endorsements that we've seen today from Vanguard and BlackRock. It sounds to me like Elon Musk and the name Tesla are still very much tied at the hip together. Would there be Tesla without Elon Musk? Despite the fact that a lot of his attention is in other ventures, that is, I think, what the stock market is telling us today, is that Elon Musk and Tesla may still be one and the same.
Great, and thank you for being with us today, Anna Rathbun, CIO of CBIZ Investment Advisory Services. Thank you. And that's Market Insight. Don't forget you can watch more videos on Reuters.com.